Peter Ferdinand Drucker was an American management consultant whose writings contributed to the philosophical and practical foundations of modern business corporation. He said, efficiency is doing things right. Effectiveness is doing the right things. Hello, everyone. Today, Chris and I will be presenting a case study from the Minnesota Department of Revenue, wherein the DOR used data mining techniques to improve their tax audit selection procedures, which eventually helped them increase the operational efficiency and effectiveness, and also led to an increase in cost savings and revenue collection for the DOR. Let us move into the agenda for our presentation. Our agenda covers the following topics. I will be explaining the executive summary, the problem statement, the key challenges presented in the case study, the implementation of the solution and that addresses the problem statement. And then further, Chris will expand on the process of the implementation, the results obtained from the implementation, and will conclusively offer possible alternative solutions as well. Let's move into the executive summary. The executive summary encompasses the problem, which is the tax gap of the $345 billion, out of which only 15% was accounted for. The major cause of the problem, which was the inability of the Minnesota's DOR to effectively or efficiently select audits for the collection procedures. The key challenges faced while trying to implement the data mining techniques, which was the feature selection procedure and the overfitting issues that the DOR faced. The steps to address the problem, which was an appropriate selection of an algorithm, which was naive Bayes classifier, and then our recommended solutions to the given problem statement. So let's move into a little bit of a detailed explanation of what the problem statement was. As mentioned earlier, in 2001, the IRS estimated a tax gap of $345 billion. A tax gap is defined as the revenue owed and the revenue collected by the government. Tax revenue is the primary source of revenue for the government. Therefore, it is crucial and critical for the government to be vigilant about minimizing this tax gap. However, IRS was only able to recover $55 billion of the $345 billion in 2001, which means they were only able to collect about 15% of the taxes owed to them. The inability to efficiently select companies to audit for tax collection procedures was one of the most prominent reasons behind the large tax gap. So let's move into the process of how these audits are selected. So the current process for audit selection is very human intensive, which means that the tax analyst's experience matters a lot in choosing these particular cases. It proceeds as follows. First, rules are derived from tax research, which are used to filter out several thousand candidate cases from a database or a data warehouse. This list of candidate cases is then refined. And in this refinement phase, the analysts evaluate candidate cases partially based on some pre-specified set of rules, but mostly based on their experience and expertise. If these two stages were performed well, then there's a better chance of generating cost savings and add additional revenue to the DOR. If an audit case turns out to be unsuccessful, that is, generate less revenue than the associated costs with the audit process, then the cost is not likely just the waste of time, but also a potential loss of an opportunity to work on a successful audit or a successful case. And therefore, the goal of the DOR was to utilize data mining techniques to improve audit selection procedures, particularly in the second stage of refinement. As for the first stage, where an initial pool of candidates is generated, the audit selection criteria processes are mostly confidential. The company decided to use data mining techniques to identify relevant companies to audit, apart from the obvious large companies that would have generated government revenue and are regularly audited, thus improving the audit selection process, especially in the second stage, as explained before. These handpicked audits fall under a general category called EP-Gen or App-Gen, and typically consists of cases involving small to medium-sized businesses. Data mining has an even greater potential to reduce costs for audit projects that currently generate a higher number of unsuccessful audits, which is mostly in the small and medium business sizes. This will be discussed in a greater detail when we talk about the implementation of this data mining technique, which was particularly the naive Bayes classifier. And now we will be diving into the key challenges that the DOR faced while trying to figure out which data mining algorithm to use. Multiple challenges were faced by the DOR. However, the most prominent one was the feature selection process and the potential overfitting issues associated with it. So before reformatting the data scheme, the DOR carried out PCA, which is principal component analysis or feature selection, and could obtain good results in training data, but not in the test data, thus indicating a potential overfitting issue. This was realized to be a result of the feature construction working with different tax filing cycles from various different businesses. And the problem existed from using actual timestamps, and the data schema had to be reformatted to accommodate relative timestamps. So this whole feature selection and potential overfitting issue was eventually resolved by reformatting the data schema. However, it did exist, and it was a particularly prominent challenge for the DOR to come up with solutions to these key challenges. Additionally, another key challenge was missing data handling and the noise issues. Generally speaking, a null value is one of the three. It can be non-existing, not applicable, or existing and applicable but unknown. For example, in case of annual withholding amounts, a null value could be non-existing. That means that the business did not file a return that year or did not report particular values. Or not applicable, the business did not exist in that year or is not required to report in that particular year, or is not required to report the particular withholding amount. Features derived from business registration data, for example, whatever the industry type is or the location is, fall into the third category. This, however, the feature and the domain experts felt that the median and the mean values are poor substitutes for missing values in the third category, which were particularly the business registration data. So the data set consisted of some noise as well, which was particularly contributed from the errors in reporting from businesses, as well as the errors due to incorrect data recording by the DOR. Additionally, these errors arise from these tax forms not being completely machine readable. So primarily arising due to incorrect filings or due to incorrect entry into the database. So there was a potential noise issue, there was a potential overfitting issue, there was a potential data missing handling issue, and a feature selection issue. Therefore, when we move on to the solution, we see that the Department of Revenue used the naive Bayes classifier as a data mining technique in order to improve efficiency, increase revenues, eliminate costs, and thus decreasing the tax gap, because naive Bayes is robust to the noise, is robust to any irrelevant features or variables, and it is also very good at handling any missing values. And we see here how the naive Bayes classifier works. In this particular case, I would also like to go over this particular graph, which talks about the giant companies and the small companies, and we see how the graph decreases and the benefits outweigh the costs when it comes to giant companies. However, the costs associated with auditing small to medium-sized companies or businesses is higher than the benefits that they offer. Therefore, the AppGen or the APGen category specifically targets the small businesses or the medium-sized businesses wherein the unsuccessful audit rate can be higher, and it is an area which can be leveraged to the DOR's advantage using data mining techniques, especially naive Bayes, to identify good and bad audits. Now, when we talk about threshold for good and bad audits, it was $500 per year or $1,500 per audit period. An audit period on all of the filings was about 3 years. So $1,500 per 3 years or $500 per year was considered as a good audit. Anything below that was considered as a bad audit to be reviewed. So it was a pretty effective technique, which we will be seeing later on when Chris talks about the implementation of this process and talks about the results of this process, and also talks about the importance of machine readability in these tax filings and in the accounting industry as well. So now I will hand it over to Chris to discuss the further implementation process. Thank you.
Thank you, Dee, and hello everyone. My name is Christopher McIntyre, and I'll be picking up where Dee left off. Before I delve into implementation, I'd first like to discuss use taxes, sales taxes, and the current Apgen audit selection process. A use tax occurs when an entity purchases goods from outside of their local government, say in another state, that has a sales tax lower than that of their local government. The difference would be collected by the local government in the form of a use tax. So sales taxes are collected where the good is purchased, and use taxes are collected by the local government, assuming that their sales tax exceeds that of the foreign government. For the current Apgen audit selection process, the first 50% of the cases are predetermined, regardless of their outcome. What they do is they audit the largest companies in each state zone because these companies are deemed to have the largest potential return on investment. So for the other 50% of the audits, the auditors use what is known as the Apgen audit selection process, a 4-step process. The first step in this process is that the auditors will create and refine a database query to create a pool of several thousand potential audits. In the second step of the process, the auditors will further examine this data, and using their expertise, they will narrow it down to a few hundred cases that they'll actually audit. This process could take a few days to a few weeks, so it's very labor intensive. In the third step of the process, the auditors will go out and audit the actual selected cases. Finally, in the fourth step of the process, the auditors will come back and they will examine the results for accuracy and return on investment to determine how good the actual audit selection process was. Moving on, we'll now discuss the data mining goal. As Dee stated, the first step in the Apgen process is highly confidential. The Minnesota Department of Revenue doesn't want information getting out to the public about how they actually create this pool of potential audits. So there wasn't room to use data mining to improve this. So instead, the data mining task focused on improving the efficiency of the second step of the process, actually choosing the audits from within that pool. The data mining team decided to use the naive Bayes classification algorithm to assign either good or bad to the potential audits. Furthermore, the team used, as Dee stated, the naive Bayes classification because it was deemed to be robust to noise, it naturally handles missing values, and it's good at disregarding irrelevant features, which is perfect for the feature selection problem the data mining team was faced with. The next step is to understand the data. The audit period is generally a 3-year period. So an audit would be classified as good if it would bring in $1,500 of revenue or $500 per year. To create their data, training data, the data mining team used the results from the 2004, 2005, and 2006 Apgen audit selection process. For their test data, they used the 2007 results, and for validation data, which is basically a real-world scoring of their model, but for the purpose of this case, it was referred to as validation. The data mining team and the Minnesota Department of Revenue used the models from training to actually select the 2008 audits. The next step was preparing the data. The first thing that was done was to remove inadequate cases. Inadequate cases were deemed to be cases with 1 year or less of data. This could be because either it was a new company or for whatever reason they didn't file their tax returns. In the initial phases of modeling, it was found that the models were biased towards larger companies. And this makes sense because larger companies have a higher potential return on investment. But they've already selected the largest companies in each state zone for the first 50% of the audits. So this 50% needs to be a variety of large, medium, and small companies to ensure that any company could potentially be audited. The way that the data mining team overcame this was they divided the data into two subsets, large companies and medium and small companies, and then created two different models, AppGen Large and AppGen Small. And they also used the Weka open source data mining platform to create their models. And for the AppGen Large model, they also implemented multi-boosting ensemble technique and the AdaBoost algorithm. What this did was the multi-boosting ensemble technique created a committee of subcommittees that had been created by the AdaBoost algorithm to use group wisdom for decision making. Doing this allowed the multi-boosting ensemble technique to take advantage of AdaBoost algorithm's ability to overcome bias and reduce variance. We'll now look at the results from the AppGen Large model. On the right-hand side of the screen, you'll see our confusion matrix. If something was a true positive, then this is revenue that was actually collected. If it was a true negative, then that is costs that were saved by not auditing a bad audit. If it was a false positive, then this is cost that was wasted by auditing a bad audit. And if it was a false negative, this is money that was foregone because they didn't audit an actually good audit. On the left-hand side of the screen, you'll see that we compared the manual audit selection process to the naive Bayes audit selection process. The number of good audits selected was improved from 56% to 72% by using the naive Bayes classification model. Furthermore, model efficiency was going to be measured using return on investment. Return on investment is the total revenue generated divided by the total cost of collection. Using the naive Bayes model, return on investment increased from 1,652% to 2,300%, which is a 39.2% increase in efficiency. Next, we'll look at the AppGen Small model. The percentage of good audits selected by the naive Bayes models improved from 21% to 34% over using the manual audit selection process. Furthermore, the return on investment increased from 285% to 447%, which is a 57% increase in efficiency. Our team decided to assess the Minnesota Department of Revenue's data mining team's decision to use the naive Bayes classification algorithm. We decided that we definitely agreed with this because of the improved efficiency and the increased return on investment. So our idea was to consider how could they actually expand the use of data mining and further close the tax gap. The reason that the use tax was selected for this project is because it is readily available in machine readable format for the tax returns. There were many other types of taxes, such as corporate tax, franchise tax, partnership taxes, that were overlooked for this project because many of them are filed in a paper format. So we think that the Minnesota Department of Revenue should focus their efforts on mandating that these tax returns be filed in a machine readable format. This could be done through the use of something such as XBRL, which is Extensible Business Reporting Language. It's already used by publicly traded companies to file their financial statements with the SEC. If the Minnesota Department of Revenue mandated that all companies use XBRL and expanded it to be used for their tax filings, then the Department of Revenue could further close the tax gap by using data mining techniques to select their audits for all types of taxes and not just for the use tax. If you move to the next slide, you'll see our references. And finally, we'd like to say thank you for giving us the opportunity to present this case to you today about our findings from the Minnesota Department of Revenue's case study on the use of data mining techniques to close the tax gap. Thank you.